Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives, so you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. This episode of the Australian Investors Podcast features Dr. Anirban Mahanti, Director of Research at the Motley Australia. Anirban's story is grounded in technology, software and machine learning, having spent the early part of his career as an academic working on complex problems ranging from distributed data to video on demand. During the first 30 minutes or so of this conversation, we talk about Anirban's backstory, before diving into the really juicy stuff like competitive advantages afforded to investors with a tech or engineering background, the flow of information through research and how that intertwines with investing, how Anirban values stocks, builds a portfolio and more. Then we end with some rapid-fire investor and technology-focused questions such as the emerging technologies Anirban is most excited about, why Apple has staying power, the most innovative companies and what defines them, including Apple and Tesla. And of course, we conclude with Anirban's 3 pieces of advice to his younger self. I hope you enjoy this episode of the Australian Investors Podcast featuring Dr. Anirban Mahanti. Anirban, thanks for taking the time out to join me on the show, mate.
Thank you for having me here.
It's a real pleasure to have you on. And I think now with, maybe it's just the way that markets have gone, with more investors are coming to the light, if you like, and seeing the beauty that is technology and software and all of the things that and all the possibilities that that's going to create for our world and for investors going forward. I think you're the right person to talk to. One of the things that I like to do at the beginning of every show is just to hear more about you. A lot of our listeners who are familiar with you, I put out a message to them on Facebook recently to say, does anyone have any questions for Anirban? And a lot of them wanted to know about your journey up until you started investing and then how that prepared you for investing in technology companies. So I know you were a scientist and you have a PhD, you spent a lot of time in research before transitioning to investing. But I guess I'm just interested to hear your story up until you started investing and how that came to be.
That's cool. Not many people ask me this question, so this is, I guess, an opportunity to relive when I was from little to where I am now. So, I come from India, and my father is a professor. Was a professor. He has a PhD in mathematics. From IIT Bombay. And my father traveled basically the world, and we got the opportunity to actually travel the world with him. We lived in many different places, places like Iraq, to parts of Europe, to Canada, my father spent a major chunk of his early life actually working abroad, and then came back to India and started teaching at a place called Birla Institute of Technology, which is one of the sort of engineering schools in India, started by Mr. Birla, who's one of the big entrepreneurs in India, one of the big entrepreneur houses in India. So the Birla family, the Tata family, they're sort of they'd be regarded as the big names in building industrial complexes in India. So most of my teen plus years were in a place called Ranchi. And Ranchi is a small town in India, but very educationally focused. So it had really great schools. It had a lot of people with education, a lot of people, who had explored the world and had been to different parts of the world. So that's sort of the cultural background we had. We also lived in what we call a campus. So it's like almost like a gated community equivalent here, but the difference being that a campus is where people who work at a particular place all live together, right? So you basically are living in a very homogeneous society in that sense. A lot of professors and their families around us. So education was very important to us for the very beginning. There's a little bit of other context here. In a place like India where you have billions of people. If you do not have education, it's very difficult to make a living. So you almost are by default forced to think about education, right? And business was not something that we were taught to think about early on. So, we didn't think about business. We didn't really think about money, and we didn't think about investing early on. What we thought about was, you need to work, you'll earn, you'll make savings over time, you'll spend your savings. That's sort of the background. Mm-hmm. I got into engineering school. I actually studied at Birla Institute of Technology, doing computer science and engineering. And then, like many of my peers, I wanted to go abroad to do a master's or a PhD degree. So I had an opportunity I got a scholarship at University of Saskatchewan in Canada to do a master's degree with a thesis. And picked that because we had a book on data structures written by a professor from Saskatchewan called Paul Tremblay. And we loved that, and I loved that book. And so I figured, hey, I know this university. At least I've read a book from this university, so why not go there? So I ended up going to Saskatchewan. And there was another reason I had gone there, which was, my father had actually done a postdoctoral position at Saskatchewan. So we had familiarity with the place, although nobody told me it's going to be really, really very cold there. So it gets to minus 40 degrees during winter.
Very cold up there.
Very, very cold. One of the advantages of that, though, is that, during the winter months, and if you're not Canadian, then you don't know what to do. The Canadians love winter, and they have ice hockey, and they can go sledging and all the sorts of things that they do. But if you're like from India, you just basically go to your dorm, or you go and do your thesis research. Around that time, I actually had a fantastic professor, Sir Professor Derek Eager, and I think he was one of those professors who was happy if he found a student who was keen to work, keen to do research. So he used to spend, he spent hours talking about research, problems, solving research problems together, giving a lot of guidance, but not spoon feeding at the same time. So, he's actually, I would say, he's the person who got me thinking. He's the guy who taught me how to think and think out of the box. And that sort of led me to, I said, okay, I'm going to stick here and do my PhD. And, I actually had some really good papers out of my PhD, so I didn't have trouble actually getting a job after, in fact, I had a job offer lined up about a year before I'd finished my degree. So then from there I went on to take a position as an assistant professor at the University of Calgary, which is equally cold, just slightly less. People who have been to Banff and Whistler would recognize, I guess, Calgary. Calgary is the airport that you land if you go to Banff and Whistler. Again, it's a beautiful part of the world, actually, to go there, the Rockies, the Canadian Rockies. There I worked with a bunch of really smart people. So this is sort of the background to how I learned about technology, how I thought about technology. I was working on, for my PhD, I was working on streaming videos. So at that time, to put some context in here in terms of timeline, I started my PhD in 1999. So at that time, video on demand was starting to become really hot. And there were some early trials about video on demand in Orlando in around 1994, which had closed. People were really interested in this problem that if a large number of people request a content, like a new movie comes out and everybody wants to watch it, how would we deliver it? Right now, today, that's not a problem. At that time, it was a problem because we didn't have enough bandwidth, and there wasn't enough bandwidth at server farms to actually deliver this. So you had to do some smart algorithms to actually deliver content. The internet was very lossy. So how do you deliver good quality streaming video without actually the video looking choppy? So these are sort of the things that we worked on, which was really, really fascinating. Really cutting edge stuff, and that's sort of was the background and to my appreciation for what technology can do. And then over time, as a researcher, you sort of change focus and you work on different problems. I worked on machine learning problems very early on, and so my training is in basically computer systems performance, which is essentially building computer systems that can scale and that work in a distributed fashion. But one of the key things that I started doing around 2004, 2005 was thinking about how to apply machine learning technology to computer networking or data science problems. And that, I think, one of the first papers we wrote on that subject, that was not, machine learning was not the thing that everybody talks about. Like, it was not the same thing as that. Nobody talked about machine learning, right? In fact, in the academic community, we would say that, the AI folks are the people who are actually only doing theoretical work with no practical application. Now today, actually, they feel very vindicated because everything that they've done is actually being applied. So it was the systems folks like us, the networking folks and people working in databases who were starting to use machine learning around that time. So I feel a bit fortunate that, we're all, talking about machine learning and AI these days because, have this background of seeing where it came from, where it was, how the community felt about it at that time, and what sort of algorithms we could use. Most of the time, I didn't invent new algorithms. We used algorithms for solving problems that were interesting for various applications in sort of the computer networking sort of space. So that's sort of my academic background. But I didn't actually start considering investing until 2003, 2004. And the question would be why? Well, I didn't have the money because if you don't have it, as a student, you get a stipend and you sort of barely, and one of the things I wanted from my stipend was I had a car, but you basically eat, sleep, and live, and you don't have anything left really for investing. So I actually considered investing first in 2000, towards the end of 2003 when I got the job at Calgary, and I made my sort of first investment in 2004. Which was basically I just walked up to my bank and said, well, I want to invest some money. So, I had a banker who sat with me and basically said, well, here are some options. They're basically what we would call mutual funds. So I bought a bunch of mutual funds at that time. And that was sort of my, a diversified fund, international diversified index equivalent at that time. So that was my first purchase in 2004.
Seems like a sensible way to start investing. Anirban, because you were working on these things, such as machine learning and these, databases and just all information systems, generally speaking, could you see, even though you were looking at it from a research perspective, could you see the applications in business and the potential for these early on?
Yeah, so that's a great question. So when Derek Eager and I and a couple of the other students that we had in the group, and Professor Eager, he had a collaboration with people at Washington, University of Washington, and University of Wisconsin. So it was at that time, at least within the group and within people, there it was clear that these technologies are going to become very important. So there was, the professors, had got a couple of patents done for some of the algorithms, for some of the stuff they didn't bother with patents. One of the things that, this is an interesting type of call. A lot of times people think that, just make the patents and have them there, because if somebody needs the patents, they're going to probably buy out the patents. But starting a company was, I guess, the professors had discussed and then decided, well, it's too hard, or it's not something that they wanted to do, and things like that. So I was across what was going on, and across other things too. Like when I started working, we had, like most universities would have innovation centers where they partner with people, trying to do startups. So you could see application of technology, like cutting edge technology being applied by startups. You could see where these things are likely to head. But I would say at that time it would almost be impossible to predict that something like, say, YouTube or Netflix would happen. At around 2000, it would have been very hard to make that prediction, right? Or people were, there's a lot of business model things that come into play when you think about things like YouTube and Netflix, right? So YouTube basically being a user-generated content distribution platform, right? So they solved for the key problem. So to backtrack, we had a prototype for video on demand system. So we had a scalable, which could basically scale, which could handle hundreds of movies and deliver on demand content with very little startup delays. But we could do a company, but then we'd have to find the content, Right. So at one of the big things was the business model at that time, right? The business, and Time Warner was doing a trial, had done a trial at Orlando and folded it. 1994 to 1997, they ran a trial, and they folded it largely because, again, there was issues about, well, you could do the trial, their technology would have worked in Orlando but wouldn't scale, right? So therefore, it's not a global system or even a nationwide system, so to speak. And for us, we had a system that might have worked, but how would we get the content? So there was a business model issues, right? Finding content, which interestingly YouTube solved the other way by saying, well, people upload the content, which is interesting. So there's therefore no issues with getting content, right? And Netflix solved it the other way around by basically saying, well, I'm going to do DVD by mail. And then as I build out my platform, I can go to some content providers and say, well, are you willing to give me the content to host on my site, right? So their primary business was DVDs while they were doing the video on demand, right? So I think the issue often is twofold. I think for good investments, you need a good business model and you need good technology, and you actually need both to work hand in hand. So, that's a sort of a roundabout way of saying that you can sort of see what's happening, but you can't really, even if you have your pulse in it, it's very difficult still at early stages to predict what's actually going to work out and how it's going to work out.
And this is the thing, I think, with these early stage businesses, which I'm sure we'll get to. You were at the coalface with some of this technology, and you were still recognizing some of the challenges. Yet, as you say, it was too hard to predict who would be the winner or if there would be a winner. Were you surprised that YouTube became the dominant platform? Like all these years later, are you surprised that you look back on it and you think, I thought maybe it was someone else or a different type of business would have solved this problem?
Well, okay. So and here's the thing, right? So what happens is YouTube started really getting traction around 2004, 2005, right? And so I have an interesting story with YouTube. I had a student who actually has been very successful, and she was an undergraduate student. She came to my office, and she started actually doing masters, and I had got her looking at some machine learning based problem, and she came to my office and said, "How about we study how the traffic patterns are evolving for YouTube?" And this is about 2005. So at 2005, we actually started collecting data on YouTube traffic in the local networks, so the University of Calgary's network. And we could see some very interesting trends of how YouTube was being used. So around 2005, 2006, I had no surprise in my mind that YouTube would actually be really successful because they had some very, very interesting properties. Like, you could see that there are thousands of videos, but only some actually mattered, and everybody actually flocked to those popular content. So they had like this Pareto style distribution of things, and they could do really interesting things based on the fact that they have skewed popularity distribution. And in fact, they were able to feed on that because what they were really doing is basically saying, well, these videos are really popular, and therefore surfacing them up for other people to watch while trying to also discover interesting new content. So I would say that once sort of the technology starts getting some traction, it's easier to tell which one is actually going to fly. Of course, again, there's this could have played out differently, right? Because YouTube ultimately got acquired by Google, and it gave them all the engineering muscle needed to actually scale the service over time. And the early business model, who knows what the early business model was, but the current business model is basically ads, and that would have played out, I guess, differently had YouTube had been acquired by Google. So again, there's always, I think, a lot of doubt in terms of how things may shape up for early stage businesses. But the fact that YouTube could actually be successful in terms of popularity of the service, I think that was well established by, I think, 2005, 2006. I think in 2006, Time magazine put YouTube as sort of the person of the year. It basically said you as the person of the year as a tribute to user-generated content. So yeah, so almost like at that time, you could see that user-generated content is going to be king. And from maybe 2005 onwards to now, user-generated content is king. And there have been various manifestations of user-generated content, right? Whether it's Facebook or Pinterest or Instagram, but they're all user-generated content that's actually driving this boom. So I think that was pretty clear at that point, that user-generated content is going to be king. But whether or not, which business is, again, a different question, because you really need to understand the business model, the economics, their go-to market. That's a whole different ballgame. But identifying the trend, once this trend is established, I think if you're in that area, I think you can do it.
And we'll come back to that in a few moments. But maybe we can just go back to effectively the segue from your research career into investing, because you bought that first share, or sounds like it was a mutual fund, index fund like. How did it come to be that you came to Australia and ended up at the Motley Fool?
That's interesting. So I spent from 2004 to about 2007 in Calgary. And then so the family decided we're going to go back to India. So then I went back to India. My wife was working at the All India Institute of Medical Sciences, and I decided to take up a professor position, an academic position at Indian Institute of Technology at Delhi. And sort of, I think for me, what happened is, after having spent so many years outside of India, getting used to India was hard. It was just a tough switch. And so I had these mutual funds that I had purchased. We basically sold everything around 2007. So basically, I missed essentially the GFC altogether. The GFC, for me, the GFC did not happen in many ways because I was in India, and at that time I was not investing, or we had some investments through the broker, but it was like, it was not significant of any form, so it didn't really matter. And so between 2007, sort of April, May to 2009, February, I was in India. But it just the sort of getting used to, and maybe I gave up too soon. When I think about it in retrospect, maybe I gave up too soon. People usually say that if you can survive 2 years at an IIT is like a top class school with really smart kids. So you basically have to find something that you can be passionate about, and then you should be able to stick. But people usually say that if you stay for 2 years, then you're going to stay. But if you leave with if you're going to leave, you're going to leave under 2 years. And I've seen that happen with a lot of the colleagues, because they sort of attract top talent from all of basically Indians who have gone abroad and done different things, and they try to attract those people back. But yeah, I didn't stick around for that time, and I was looking for some other options. And an interesting option came up in a place called National ICT Australia, which was sort of a government-funded sort of premier research laboratory set up in Australia. It was set up during the Howard government days here. And the idea was to try to build sort of Silicon Valley equivalent in this side of the world. Realizing that we don't have something like that here. And the model was interesting. The government would fund in 4-year cycles this institution called NICTA, and NICTA's goal was to hire some of the best people that they can from within Australia and abroad, and sort of create that hub. And this was where you would do research and also be involved potentially with spin out of companies. So you could do commercially. You could do either commercially applied research. You could do theoretical research if you wanted to. You could do but you could also apply research to commercial. So NICTA, for example, has spun out a bunch of companies. I guess a good example of a NICTA spin out that people might be familiar with is Ordinate. So Ordinate was actually spun out from NICTA. There are a few others, but I think.
Oh, right. Okay. Yeah. That's right. I do remember that.
Yeah. So Ordinate was actually a spun out from, it's actually from the same group I used to work with, but this had spun out just before I had joined. So, so that was sort of the idea here. Okay. And I thought that's interesting that, I don't have to choose between going fully commercial, but I could be involved with doing some research that maybe can be applied, and sort of like the people that were involved. So I came here. And so I spent about, from 2009 to about 2015 working at NICTA. And it is sort of here that, that this was after a while that we had we had sort of decided we were going to stay in Australia. So we had some longer term stable outlook. We had some income coming in, so investing sort of was then sort of the next thing to think about. So again, actively considered getting into investing around 2009, sort of mid 2009. I was back looking at the ASX, and I think all my initial investments in the ASX in 2009, 2010 were just horrible. I think I made all the classic mistakes that anyone could make. I bought a bunch of mining companies, exploration companies. I made these decisions based on familiarity. So, as I mentioned to you, I studied at Birla Institute of Technology. I know the Birla House is a big deal in India. So the Birlas had a mining company here called Aditya Birla Mining Limited. So I bought shares in that, thinking, they have a huge backing. They have they're mining copper here. They would mine copper and then take it to India and, melt it there. But what I forgot, or I should have remembered, is that Birlas are very shrewd business people. They would not run a mine on loss. So what I found, what these guys did was very interesting. If the copper prices went up, they would operate the mine. The copper prices went up, they basically shut down the mine. Just basically shut down the mine.
Right.
They'll just close it, no mining, because and commercially, I think for them it made sense. They were the majority shareholders at like 51%. So for them, spending money on a loss-making operation made no sense. And anyways, so I also at that time bought into another company. A lot of Australian investors must have bought into, called Linus, the rare earth miner. And I had a beautiful story about rare earth and how it's important. And they're mining their plant in Malaysia for refining. But gosh, that company had such trouble sort of ramping up. It's actually now producing stuff. At that time, I own shares. They were not producing anything. They were just still in the mining sort of phase, and they're trying to ship stuff to Malaysia and getting this plant operational. So I made all the classic mistakes, and I forgot to do the detailed research that rare earth doesn't really mean that it's rare. It just somebody decided to give it the label rare. What I discovered is that as soon as majority of this, it's rare maybe in certain parts of the world. As soon as the Chinese firms decided to ramp up capacity for production, the price would come down, and then this plant in Western Australia was no longer feasible, so they'd have to stop. So I did all the classic mistakes around the 2009, 2010 sort of mark. And around the same time, the Motley Fool sort of launched. I think the Motley Fool launched here in Australia around 2011. And so I don't know how, I just landed up on a Motley Fool website, and I started reading the stuff, and I sort of identified a lot with the way the communication was being done. So the communication was targeting people who wanted to learn about finance, but in an easy way, or wanted to learn about investing, but in an easy way, and who probably didn't necessarily need to have a finance background. Right, and that's very powerful from an investing point of view. Like for someone like me, who I can understand numbers, but I don't have a finance background. Like I don't have a finance degree, right? So, so for me, that language really mattered a lot. So between 2010 and 2011 is where I discovered the Motley Fool. Read a lot of articles. I joined Share Advisor here in Australia, which was sort of the first service as a member. That was launched here, and in the Share Advisor had a bunch of US recommendations, and that's sort of where my sort of light bulb sort of flipped in my head and turned on. And I said, here are all these interesting companies, Netflix, and I understand what Netflix is doing. And here's a smartphone company called Apple. I understand what it's doing. So that's how I sort of landed up finding the Fool in the US, and I became a member of Rule Breakers, and which is run by David Gardner, Motley Fool co-founder David Gardner, and Stock Advisor in the US, which is run by Tom, our CEO, the Motley Fool, and David. So they run, they have like 2 picks a month, and sort of that style of finding these companies that are sort of at the forefront of innovation, that are growing quickly, that are doing interesting things, that are actually having an impact on society. And you could see a lot of these companies are actually technology companies, and I could see how a lot of these technology companies are doing things that actually I'm really, really familiar with. So that really piqued my interest, and I thought, hey, this is really cool. So I should start digging in and try to understand what these companies are. So, picking up annual reports, looking at their earnings calls, and so that's where it sort of started, and that's what I really got interested, because I could now see, well, these are research papers I'm reading. This is what the companies are talking about. And there is a connection that you can establish. Almost always what I found is that there was a lag. The stuff that I had heard 5 years ago is actually being done now, right? And even for people, what I felt is that a lot of these things, people talk in generic terms, but you actually can figure out, well, this is actually that particular technology that's being used, which was done there first, and published there, and then developed for for several years before it sort of became common knowledge in the academic community, and that's now sort of seeping in slowly into the business community, and then that's having its results in terms of how the company is evolving. So that sort of became my thing. That okay, there is a big opportunity here to think about application of technology and how technology companies are using them to sort of grow their markets, do new things, find new customers, launch new services, etc. Right? And so that that became the passion at that point. So I spent a lot of time doing that. Then over in the US, the Fool has this program called what's now called Farm Team, sort of, which basically means they had this thing called ticker guides, and the ticker guide basically is a person who promises to follow one or two or three companies, whichever companies they're following, and they would post on the board. So I was a prolific board poster on the Motley Fool forums in the US, especially for companies that I enjoyed, and I did my deep dive, something. So. And I was trying to learn things from other people who have been investing for 20, 25, 30 years. Like, okay, what's your framework? And okay, this is how I'm thinking. And a lot of back and forth with interesting community people who are, really interested and delighted about, investing, all things investing. And that's sort of what got me even more interested. And that's sort of my journey, at which point I thought, there was a point at which I thought, it would be really cool to actually do this full time instead of doing this on your spare time. And that's what made me think, okay, well, maybe I need to try to find a job that allows me to do this. But as you would be familiar, it's really hard. If I wanted to find another academic job, or a research job, or a job at as an engineer in a research, as an engineer in a company, I could because I have the experience to show. But how would I find a job in a finance company if I have no experience to show? So I should first applied for a Motley job at the Motley Fool and I had applied for a few others in sort of 2015, just see what happens. And I think the first time that I applied, I got a thank you for your application letter. I said, okay, that's fine. Never give up, try again. so I tried again.
Yep.
I got an interview, and I was, at least when I got the interview, I was able to demonstrate that, look, I'm interested. Yes, I might not know as much as you guys, because you guys have been doing this, but I know something. I have something else to offer that I can sort of marry here with investing. And so Joe Mega was the hiring manager, and he hired me in 2015 August to work on Motley Fool Pro, right? Recognizing sort of that I had worked in the past, done these things on the forums. I was contributing to the forums. I was writing forums. I was ticker guiding and things like that on various stocks in the US on the US boards, and that's sort of how I landed up at the Fool.
There's so much to unpack in your story there, which we'll get to in just a moment. But now you're director of research at the Motley Fool Australia, you lead Motley Fool Pro and Motley Fool Extreme Opportunities. Did Joe ever say why he hired you? Is it because of the technical background plus the passion that he could see on those boards? Is that principally what it was, do you think?
This is a question. I guess this is a question for Joe to answer. Um, I don't. Well, I think one of the things, if I might generalize this, I think one of the things that I think we at the Motley Fool have done really well is we have tended to hire people not necessarily based on their financial background, right? And I think this
Mm.
has been a strength of the company in is to hire people. Is the name Motley, right? I mean, you hire people with different backgrounds because then there's different backgrounds. It's almost like 1+1 is not two, but more than that because. Um, but the addition of people with different experiences allows us as a group, I guess, to look at companies differently, right? And that's an edge because, effectively one could say, and I don't want to generalize this, but one could say that if you just look at companies as numbers, then, well, effectively you're going to have no edge, right? Because machines can look at companies as numbers as well, and they would probably do it much better than in humans on average, right? So,
Mm.
um, investing just based on, say, PE or revenue growth or gross margin growth or anything like that, anything that can be formulated into a decision tree or can be formulated into one of the machine learning algorithms, human beings over time would have no chance, right? So in fact, qualitative factors are where I think we have the best chance of being different than machines, right? And I think that's that sort of theme where qualitative thinking and different experiences actually add value. I think I would say that that's sort of the thing we try to look at when we are looking to hire people is that what is it that they can bring in terms of their thinking that's different, novel. How do their life experiences shape their thinking about the world? Because that's very critical in sort of long-term investing, right? You in long-term investing is really all about figuring out where the world is headed, right? So, you want to know where the world is headed. So have a rough picture of where the world is headed and then try to invest based on that, right? With short-term investing, really a lot of okay, are the earnings expectations going to be met, right? And I think they're two different things. So I think that's a qualitative thinking focus. I guess the other thing I'd say is that at that point, there was a lot of interest here at the Fool to look at things like focus a lot on software and had a computer science software background and understanding of software technology, technology such as how software interfaces with humans, right? And understanding that, or where you would apply machine learning, where is it useful to apply machine learning, where it may not be, because and it's very easy for companies to say, well, we are applying machine learning, or we are doing, and they might be because a lot of the code base is freely available, right? I mean, there's a piece of software called Weka, which it's basically open source software for a lot of machine learning algorithms. You can just download it and apply it, right? Question, but in computing, we would say garbage in, garbage out. It also depends on what you're inputting, what you're trying to solve. If you don't know what you're trying to solve and what you're inputting, you're going to get garbage out. So there's it's very easy, I think, to say that we're applying machine learning, or you're a learning machine learning company or an AI company. So how do you sort of separate those out? You sort of having a little bit of an eye for that would be helpful. So some of that, but I think it's just at a high level, it'll be the difference in experiences because we have a lot of non-traditional people in the company.
You do indeed. This conversation is kind of just bouncing around as we go through some of the things that we wanted to talk to you before we set out. And one of the things that's kind of going to take us on a bit of a tangent is you mentioned earlier on, and I was going to ask this when you talked about your research days, the kind of lag between the technology in the academic sphere and then the implementation of that in the commercial sphere. We talked about YouTube earlier on. In the late 90s is when you were thinking about these technologies, but it wasn't until 2004, 2005 when you knew that YouTube was going to be a big deal. And we talk about Ordinate, which is on the ASX AD8, it's the ticker code. You worked on that many years ago, and it was spun out of Nicta. Do you think that you having the background that you have and knowing that there's that time lag between research and proof of concept, if you like, and implementation at a commercial scale, is that time difference your competitive edge or one of the key sources of your competitive edge as an investor today?
That's a great question. I'll clarify one of the things. So I didn't actually work on Ordinate technology, so just so that nobody gets confused,
Yep.
because Ordinate was spun out before I actually came into Nictas. So just a small clarification. But I know Aidan Williams. I've interviewed him in the past for a full event. I've talked to them a number of times, and I really like the company. So that is one of the, I found that is a competitive advantage to some extent, because knowing sort of what the research. So I guess if I had to backtrack, in computer science, sort of in sort of the science world, people solve problems that they think are interesting and new, right? So an example might be that you want to figure out how to stream movies quickly, right? That's an example. Or it could be you might be interested in a problem such as how do we make a distributed energy sources all work together, right? So these, at a very high level, people will structure a problem and then try to find solutions for that problem. And sometimes it would involve making changes to the existing landscape. Sometimes it will involve inventing new things for it. So understanding that and is useful, because if you think of the pipeline of innovation, right? You have professors and researchers doing research. So those are the same people actually teaching undergraduate students. A combination of people who are doing engineering degrees and are doing research and graduating out of research programs are the people who are actually going to go and work in companies. So the ideas basically flow in many ways, from academics down to the industry in that sense. It's the flow of people and the flow of ideas. And the ideas are all public domain, but really it is the ideas travel with the people to a large extent, right? So that really helps, right? And knowing that flow and knowing where to look actually really helps. If you know which sort of places you're looking at, and are they sort of, the bleeding edge, as I like to call them, that would really be helpful.
Because this is one thing I think about so if we take that flow analogy and we apply that to investing, what I see oftentimes is that some really good investors come through the system, and they might come through for 5 or 10 years, right? And although it's pretty crude and harsh for me to say, sometimes those investors generate a lot of alpha because they have some type of skill set or toolkit to look at problems that are affecting people here and now. And I think you know this better than I do, that if you solve a problem too soon, it may not get you mentioned Time Warner earlier on, it might not get that adoption. If you solve it too late, then you're too late to the party. And what I find with investors is they kind of find this problem. Like, let's say it's, hypergrowth investing, or that B2C consumer sticky software that we see around now. A lot of these companies are really doing well. The next iteration, in my mind, might be B2B software, or software purpose built for developers, like low code environments, those types of things. I feel like with investing, it's kind of like you have a moment to analyze these companies through this lens, given what you learned from academic history or your work experience early on. I don't know if I'm going off on a tangent here, Anirban, but I don't know, that pipeline of ideas, do you think that pipeline of ideas also applies to the way we look at problems as investors? Or do you think, this software stack that we see now, this is something that's going to be here and it's going to be here to stay for quite some time?
It's actually a fantastic question. And I think about this a lot. I don't have a firm answer, but I have a couple of thoughts, and these might sound like random thoughts, but I think I think one of the things that's true especially for software technology, the software technology changes rather rapidly. So, and if you go back to the early days of the internet by design is distributed. The algorithms are distributed, the nodes of the internet are distributed, and the internet is fault tolerant largely because it's distributed. You can't break the internet that easily because things are distributed. And it sort of has these design principles that allow things to be built on top of it, which, and and you can keep building. So you can build, you can think of things as layering on of the stack, right? And more it seems that the action is shifting to the top, right? So you could say that in the early days of the internet, the main thing was how do you make the internet go faster, which meant you needed to focus on companies such as Cisco or Intel, which were building chips and building routers and building pipes that connect these various points, right? Now, once you've built that, you want to build applications that run on this. Now people are building applications on top of applications, right? So think of the ideas of, app stores running on messaging applications, right? So this is like further abstraction. So abstraction is a big deal in software technology and internet technology. But which basically means you have to just be agile, I think, in terms of how you're thinking about different things, because you can very quickly see things move from sort of one area to the other. The other thing I think is I'm really cautious about what I call formulaic investing, right? So if you think about formulaic investing, here's one way to invest in companies. You can say, well, there are companies which have a two-sided network, right? You have buyers and there are sellers, more sellers, right? But what happens though is once a lot of people actually understand that arbitrage that you typically get, the pricing of companies, and I know people want to talk about valuations, but let's putting valuations aside, the fact that this sort of network can keep growing for a long time until something happens is, if a lot of people recognize that, then sort of the arbitrage that you get by investing early disappears, because a lot of people are sort of investing, pushing the price up, right? So, things like network effects, or sort of the ideas around various types of moats that exist in software, I think that can be fleeting, because to a large extent, what happens in technology is a big once you have a winner, it wins, right? And if a lot of people have identified the winner, then, well, the price goes up. Then the next question to think about is how long is the winner going to keep winning? And often it is not that the winner is displaced by another company doing the same thing. The winner is actually displaced by another company doing something completely different that makes the previous iteration obsolete, right? So, and I think that's a very important thing to realize. I think the thing to realize is you want to get into like this sort of investing. If you want to get these real multi-baggers, you want to get into companies relatively early. Then you want to sort of own them for that life period where they're going to be interesting, growing, expanding. But you sort of have to also figure out, at what point are they going to get disrupted? And I feel like disruption is likely to happen at a more rapid pace now than in the past, for the same reason as innovation is happening at a rapid pace right now than in the past, right? So I think there's, if you're getting early, you have more upside. But again, if you're late, I don't know how much upside you have, because when is disruptive event going to cause the current disruptor to be disrupted, right? So sort of, I think again, everything's a moving target here. And watching what is going on is really important. And I guess the most important thing in my mind is, we can talk about modes, but I think the most important mode is how fast can you actually change. Your willingness to innovate is probably the most important thing for a company. So a company that can innovate at a rapid pace is the only one which is actually going to have the longer lifespan, lifespan, versus the ones that are slow to innovate, which has also, where actually different, network effects happen. So one of the things that I try to see is that if your company is a leader in something and doing something very interesting, they are likely to attract the best talent, right? And attracting the best talent already puts you significantly ahead of the second best, because the best people are working here. They're coming up with the best ideas, which in turn causes other people who have great ideas to come and work here because they want to, participate in a great idea, right? So great ideas and an ability to execute on great ideas attract other great ideas until something happens to cause that to be disrupted, because maybe you just became too comfortable in what you were. you are doing. So I think that's sort of, yeah. So I like to keep an eye on the innovation engine and how quickly people are trying to innovate.
I guess one question that comes from this then is how do you keep an eye on things? So, and this is a question that I got asked to ask you was how do you keep on top of innovation? Like, do you rely on certain resources, networks? Do you follow people on social media? Like, how do you kind of stay abreast of that information? Because there's so much to take in, right? When we talk about all the different themes and trends in technology today, it seems pretty overwhelming, especially for someone who may or may not have that grounding in the hard sciences or computer science.
So there's no like a cheat sheet here. So a couple of things that I find useful. I find useful following technical conferences. So that's, and I don't read the papers. I often actually just actually look at the abstracts and the conclusions, and and I just know the venues to look at. So I look at the right venues, I think, and then just try to understand what's going on, get a picture. Another thing that I find valuable is if there are probably maybe 24, maybe odd VCs that are worth following, because again, they're sort of leading companies before companies go public, right? So they have their feet with the early sort of tech, right? So, and more and more VCs are willing to share what they're thinking about, how they're thinking, how the protocol stacks are evolving. Sometimes there's they have difference in opinions and things like that, but I think a lot of that knowledge is public. That's worthwhile following. So I think those are primarily the information I look at. And then if I have invested, then sort of, the company's earnings calls can also actually tell you, give you good indications, or, the investor days give you good indication, because you could sort of, once you look at this enough, you could sort of say, okay, well, does this make sense? And, is this problem real? And, what is sort of the state of the art and things like that. I guess that comes a little bit with experience, but I think I find following VC firms, like, if you're in software, for example, you probably want to follow benchmark, right? If you don't follow benchmark capital, then or benchmark venture partners, then you're missing out on, they're the guys who are spinning out some of the best software companies of our time, right? And and the other thing that, the folks at Benchmark, for example, have done recently is they've released their early stage pitch discussions, and that's actually fabulous, because you could see the story. Oh, this company was pitched to us, and so there's one on Shopify, for example, and they had this expectation of where it is going to be, and you can sort of look at that expectation, look at the business, then look at the expectation they had, and see where it has landed, and sort of see the divergence or non-divergence of their thinking, right? And I think there's a little bit of, like, the type of investing I do, I think there's a leap of optimism involved, right? I mean, you basically have to be optimistic the future is going to be better than the past. And you are investing sort of in the leader in that future, and investing in that leader who's building a better future. If some of those companies work out, then you'll be fine. Like, I mean, it becomes a game of odds in that sense that, if you do this enough number of times and you have a decent success rate of finding these, then I think the upside return is large enough that it compensates for the downside return. Like what I say is that, maximum you're going to lose 100%, but your upside is theoretically uncapped. So, 110x can make up for a lot of mistakes.
One of the things that always comes to mind when I think about this type of like this hypergrowth investing is that oftentimes, there's the piece of like what companies or which companies and thematics do I want to be exposed to. That can oftentimes be kind of the easier question for some people to answer, particularly if they're new to investing. The harder question can be, well, how do I weight those positions? How do I build my conviction?
Mm-hmm.
Would you say that it's more of a kind of equal weight approach? You kind of just the way you think about portfolio construction is you take a piece and then you take more as the thesis improves. I think David Gardner's line is add to that excellence and sell mediocrity. Is that something that you subscribe to?
Yeah, so that's actually probably my favorite line, and I think David Gardner is probably the most I guess the growth investor, probably one of the greatest growth investor, who's probably the least known among the list of those great growth investors. So I think that's so. This line that I buy excellence, I add to excellence, and I sell mediocrity. This is fantastic because it removes everything. And people will say that, oh, there's no price component in it, but that's, you're betting on excellence to find those new things. And also in a cynical way, you could say that a lot of people have problem with excellence, right? If it is excellent, well, it's likely to destroy some industry, some existing incumbent industry. There's going to be a lot of people opposing excellence, because excellence is also going to change the world, and changing means that some things that are not that good are going to be left behind. So it creates this really nice tension, which often excellence is actually underpriced for that reason. That there's just a lot of people betting against excellence. And this is, one of the things that I find very interesting is excellence is always finding the excellence. You are almost always likely to do well. So in terms of position, to answer your question, what I do personally, and again, this is just what I do, and everybody's circumstances is going to be different. I always start with a small position. So my starting point is like a 0.5 to a 1% position of my portfolio. And that's what I start. And then I'm basically just watching the company, and I'm trying to understand, because there's no way I can, or anyone can, at least that's my belief, that know all that you really need to know about a company in 2 months of research or 1 month. Because as the company evolves and has these earnings calls and it does things, and new products come out and new services come out, things change, right? And you really need to understand sort of that arc. So I really believe in starting like 1% position and then following. That 1% position is sort of, my way of saying I'm going to follow this company. And then I think the other important thing, and I've done this mistake many times, is it's very hard to add when the price is up, because the company is executing and more people have started realizing that this is a good thing. Actually, that's when the company has become de-risked, right? So the price goes up because it has de-risked and its future is more certain than it was some time back, unless there was like large mispricing, for example. So I would add on success, as long as, and I'm a big TAM focused, so total addressable market focused investor. If I think the total addressable market is huge, then just by basically looking at companies' current market cap, companies' current revenue, you can sort of guess what the upside potential could be, and therefore if there is still a substantial upside potential, then it makes sense to add on success. So that's what I do. Then I cap. The last thing I do is I cap the total amount of investing dollars that I put into companies. And what I mean by this is not the total amount of my portfolio, but the total amount of dollars I've actually put into the portfolio, and I limit that amount that I'm going to. I rarely ever try to go beyond 5% of capital that I'm bringing into invest in companies. I'm never really going to put more than 5% of that capital into a company, right? And that sort of prevents me from, doubling down unnecessarily and things like that. It doesn't mean that the position can't grow. The position can grow to becoming 10, 15, 20% just by upside, right? Because if there's upside, then the position will grow. But I do limit how much capital I'll try to, and I do it in phases.
But we have a lot of people that come on the show who might be chartered financial analyst designation holders or charter holders. We have people that have spent, their research careers studying finance or investing, and we often talk about value investing and the idea of putting a value or intrinsic valuation on companies. Given that you've kind of taken a different lens, and you've got a different toolkit for analyzing businesses, and I think this is kind of the makeup of your portfolio construction as well, which is where this question leads from, is how do you think about valuation of these high growth companies? Because obviously in the early days, the range of outcomes are very wide. Are you putting traditional valuation models against these companies and saying, this is the discounted cash flow analysis, this is the discount rate for year 1, year 2, this is the terminal growth rate? Are you thinking that way? If you're not, I'd just be interested in your higher level thoughts around, maybe why or why not value investing, the traditional approach to value investing, can't be applied to these companies.
So I think, I think this can result in fights, right? What is value investing and what is growth investing? I mean, investing is investing, I guess, is the answer. I think here's the thing: every company is effectively should be theoretically valued as discounted free cash flow, right? So you free cash flow into the future and you discount it back appropriately, whatever that discount rate should be. And then, but the problem is we don't know the discount rate, so we don't know what the free cash flow is going to be in the future, and we don't know how long into the future should we be looking at, right? Nobody would have predicted in year 2000, 2001 that Amazon today would be growing at like 25%, even today, right? No model would have built that in. So that's the problem of building model. And as a scientist, I built a lot of models. It was one of the things that I used to do as a in a computer systems performance guy, build models. And one of the things that I know from models is all models are wrong. This is a George Box line, and very few are actually useful. So I do build models, but I only build those models which I think can be useful for understanding. So one person, and he's a friend, Ryan Newman, the analyst who works with us. He can build fantastic models which I think are actually useful. He can build a model for Afterpay, which is useful. He convinced me to say, to build a position for Motley Fool Pro in Afterpay. Largely, when he first came to me with the idea, I said, not Afterpay, and then he said, well, I'm going to show you a model, and then, built a model. And I said, okay, now I get it. I see where this thing is going to, and how this thing is going to work out. So the model, it's not about the precision of the model. What he was able to show me was the economics of the business via the model, which I was, closing my eyes to that. Okay, there is economics here, and the economics can actually keep scaling up and up and up based on how this business is working. So I think that sort of model is useful. I personally don't build very many complicated models. My framework is relatively simple. I try to find companies which are doing something very interesting, and they're doing something very interesting that can be impactful, and then the thing I'm interested in is what is sort of the addressable market for this thing that they're doing. Then I do try to account for the fact that, I look at the team and say, well, if this team is excellent and they have a, ability to be innovative, they can innovate in other things. It's the intangible. There's a lot of value to intangibles, right? So a person like Steve Jobs, right? He has been involved with how many companies and how many of them are successful. You think of it, he did Next, he did Apple, he did Pixar, right? And for a long time, the Jobs family was the largest shareholder of Disney because of the deal to sell Pixar to Disney, right? That's, so the ability to spot talent and groom talent is also a big deal, right? So I think, I try to look at the team, I try to look at what they're saying and how they're executing. And to be honest, there are very few companies in the world that have that bar of extremely high talent, supreme innovation capability, and ability to basically take their brand and do different things, right? So I think there you have to give that value to the optionality. Now, for the companies that don't have this optionality, then you think about them. Well, okay, you are operating in, let's say, a business software, business to business software space. How big is the opportunity? Who are the competitors? How much share are you likely to get? And and let's look at the current growth rates and think how far you can continue maintaining that growth. I think one of the important things to realize is that if a company is growing at 50% today, and this is a common mistake, it is what's the probability that's going to grow at 3% year 11 onwards? You know what I mean? Like, that's the problem with taking a traditional model. So there's nothing wrong with a DCF model. The problem with the DCF models that get built is, well, they take the terminal rate of 3% or 4% or whatever it is year 11 onwards. But if a company is growing today at 50% or 80% or 100%, it could potentially be growing at 25% on year 11. And that the terminal value is going to then account for a lot of the actual value of the company. So that's classic case is Amazon. Like, another thing that I like to do is I draw parallels. So, and it's not perfect, but it sort of tends to work. Like, if you want to compare Amazon, look at Amazon and then compare that with, say, Walmart, right? And you can say that, well, Walmart's revenue is this, Amazon's revenue is this. Technically, there's no reason Amazon's online sales can't actually match Walmart, over time, because the pie is also growing, right? I mean, over time, the other thing that we need to realize is the pie is growing. So the middle class is growing all around the world. So the pie growing, yes, there is more competition, but um, companies can grow. So I think the fact that they can grow for a long time is very important in sort of the framework and approach I'm using. And then I'm willing to be wrong for a long time as well. That's the other thing, right? I'm willing to be wrong for a long time as long as I don't lose faith in the team and the thesis. Because sometimes it takes time, right? There are companies, like take an example, the company like Disney, share price would not have done anything for like 4 or 5 years until they did the pivot. So sometimes you also have to think about the ability of a company to do a pivot, right? And then I think here it's important to realize that not all companies can do a pivot. Some companies that have sort of the brand recognition, the bandwidth, not the bandwidth, but the balance sheet capability and the flexibility and the cash flow generation to be able to do the pivot, right? And I guess the IP that they have that allows them the opportunity to actually leverage that IP and do a pivot, that is really important. So sometimes some companies can be late to a game and still win. Disney is a classic example. So I think, again, company specifics become really important. But I'll just reiterate that truly great companies, there are not that many in the world. Like, and that you can also see that in returns, right? The majority of returns are generated by a small percentage of companies. Maybe 20% of the companies generate 80% of the returns. That's true in the stock market. That should also be true for the portfolio. And if you you maybe try to skew your portfolio to find those 20% companies that are actually driving the returns. And then if you have majority of those companies, you'd still see 20% of the companies in your portfolio delivering most of the returns. But it just turns out that even your losers are actually doing better than an average company.
It's one thing that I've had to think a lot about, because I don't know, but I have this online investor program where I teach people to do valuations and invest. And one of the things that I taught in that course is, sometimes you do a discounted cash flow analysis over 5 years. And it wasn't really until I learned more about this that you're right. Like we kind of have this hard cliff that a lot of traditional value investing models fall off of, which is once it hits that forecast period, it kind of just sinks down to that 3% growth rate into perpetuity, when in reality, that's not the case for many of these companies. They're growing much faster than that. And in my mind, you've got to model them accordingly. And I wasn't doing that. So I'd miss a lot of the upside because of that traditional value investing lens. You mentioned, earlier on, we talked about that buy excellence, add to excellence, sell mediocrity. One of the questions that a lot of the people listening to this would have is, well, how do you decide when something becomes mediocre? Like, how do you decide when it's time to sell? And I'm thinking, I know a couple of companies that you follow closely are Tesla and Apple. I follow Apple closely. What would be a signal, like hypothetically, what would be a signal that company has slipped into mediocrity? You don't have to use those as examples. There are many others, but what, if any, examples do you have that you could kind of lend us to support that idea that we're trying to formulate in our minds?
Yeah, so let's take Apple actually, because I think I can give a lot of context around Apple. And because both those companies that you mentioned, I have shares in them. So Apple is an interesting one because one of the things that Apple has traditionally been valued at much lower price to earnings multiples than, say, the S&P 500. And that's because people have viewed for a long time Apple as essentially the iPhone company, or a company that's tied to one particular gadget and so on, right? But I think here it pays to sort of think, well, there are all these people that are willing to line up and buy Apple phones, that are willing to upgrade their equipment year in, year out. There are all these people who love this products that this company makes. Now, what is the reason behind it, right? And you can call it brand, but you know what I call it? I call it, and this is there in early Steve Jobs videos, is how the company thinks about their devices. They think of the company's devices as toolkits to enable things to be done. Or as I like to call it, I think of them as the best example of bringing human-computer interaction. The human device interaction. They basically make the human device interaction seamless, and so the device disappears from the foreground. Right? It becomes part of you and it enables things. If you think about a company as achieving that company's potential is immense. because it can make itself useful in any context where human-computer interaction is useful. And that's a skill. It really is skilled at making human-computer interaction or human-device interaction seamless. So that opens up opportunities, right? So if you think about, so, when Apple's P was dropping, I was saying, well, this is silly. So, and at the same time, you can also focus on financials, saying, hey, this is a company that has cash flow like none. It is generating 60, 50, 60, 70 billion dollars every year. It has like a balance sheet that could buy off CBA. And it is selling for like 15, 16 times earnings. This has got to be crazy. So if you take that view, and people have said there's no innovation at Apple and things like that. Well, sometimes there are arcs that you have to follow. Like, they could design something that is going to replace the iPhone and kill off their iPhone, I guess, revenue stream, right? And they've done sort of that by saying, okay, we've got the Apple Watch, which is focusing on healthcare. They probably have something to do with Apple Glasses, which is going to probably replace the phone at some point. They're smoothly transitioning in people to new things, right? And as long as they can continue with this ethos of delivering this interaction, I think I'm fine with that company, because I think that company has the opportunity to find its way into different, like their foray into healthcare, right? They're the preeminent healthcare device in that sense. Like 100 million plus people actually wear an Apple Watch, which has got all these different features, right? And that's their door to doing different things. Their door, you could also see that their focus on privacy, for example, right? You can call it hogwash, but their focus on privacy, I believe, has got largely to do with their belief about how they treat their customers. So they're basically making money off their customers and not selling customers' data. But B, if you want to be successful in healthcare, this is one of the things that you want to focus on, is privacy. Right? You can't really be successful in healthcare if you're not going to focus on privacy. And you sort of you could see this arc, and then you see privacy and privacy-aware computing. This has been a huge research area for the last 5-6 years. Right? So there are technical things happening in the background. There are things that are happening in the foreground, and then there are these devices and the experiences that you can make that gives them the best shot at being successful. So I think following that. And of course, this, at some point, a company becomes a bit like, it's going nowhere. Like, one of the most innovative companies of our time was IBM, until it was not the most innovative company, right? That can happen. And at some point, you have to realize that happens. But, what I sort of, and it's very hard, because you're going to realize after several quarters of missteps. Because you can't, it's just the human nature would be that, well, one misstep, okay, maybe not, maybe this, maybe that. I have not seen Apple making a step yet. So far, I think their focus on services has been excellent. Their focus on new devices has been excellent. And their way that they are expanding their base is excellent. The final thing that I like to remind myself is, I think you need to realize a company like Apple can make a mistake and still be great, as long as your time frame is long enough. And an example would be Microsoft here. Microsoft completely missed mobile, but the fact that it had Windows with a very sticky client base generating a lot of cash enabled them to invest in other things, and they were successful, say, for example, in cloud, right? So I think there are some unique companies where you can afford to take this look that I'm going to be very patient. So my theory is that I try to buy companies that I think are innovative, and then I delay my sell decision as much as I can. I really don't sell. Like, the only thing I might be doing is I might try to do some portfolio reweighting if I become overweight, but I really do not sell, and I don't see any reason. I mean, why pay capital gains tax? And I know that some people would say that's not active management, but as long as there is new money coming into my portfolio, I'd put my new money into something else, but I would not sell something and move it. Because again, that just means I have to be right twice. I have to be right about the sell decision. I have to be right about the buy decision. And probabilistically, if you have a probability of, say, being 60% right with the sell decision and a 60% right with the buy decision, then the combined action is actually 36%. It's a lower probability of success, right? And mathematically, it just doesn't make sense. So I try to reduce those instances of compound decisions. Sell that, buy this. It's just a bad idea in my mind. I realize that some people would have to do that because they don't have new money coming in. But I think, if you can afford to be a bit patient, I think it works out really in your favor.
I think that's one of the things that is good for someone in your position, being in a similar position with you running Motley Fool Pro and Extreme Opportunities. You can identify businesses on the basis that, the assumption is that your members would have money coming in, and they have those. They can invest for the long term because they don't have to manage the flow of money, right? They don't have to manage fund other than their own. They can take that ultra long time horizon. Anirban, there's sort of I don't want this conversation to go on for too long for listeners' sake, but I do want to keep going on. So I'm kind of torn, but maybe I'll try and put some quick rapid fire questions at you.
Let's do it.
We close it off.
Yes.
So we're recording this in 2021. What would you say is the most innovative company on the planet right now?
Tesla. Yeah.
Okay.
It's probably got the best team.
Dare I ask why?
Well, it's good. It's probably got the best entrepreneur of modern times. I think there's no doubt. The person who can land rockets, send people to space station. Elon Musk does a lot of funny things, but Elon Musk is also very forward thinking, and he thinks like an engineer. So he doesn't think about local optimization. This is a problem a lot of people have. People think about local optimization. He thinks about global optimization. And there's a big difference between the two. It's easy to do local optimization. It's very hard to do global optimization. And he builds a team around that idea that you want to get to a globally optimal position. So I think that's a very big skill. And then people like Andreas Karpathy, who's the director of AI, just have a look at the type of work he's done, at Stanford when he was doing his PhD. Those sort of people want to work in firms like this because it allows them to work on sort of the state-of-the-art problems and then actually see their solutions in action. Right, that's a big deal for the best engineers who want to see their stuff actually work in action. So, I think again, the most innovative company I think is Tesla's. But I would go as far as to say the best AI team today on the planet, much better than what you think Apple has or Google has. And I think there's a bit like Apple. They're very frugal with their R&D spend, but they get a lot of bang for their buck. In terms of how, so yeah, in my mind, they're probably the most innovative company out there today.
Maybe I'll give you one more then. Which company do you think will be more profitable in 2030, Apple or Google?
I don't know the answer to that one. It's hard to say. It depends actually how you define it. So are you defining total profits as total net profit or cash generated by the business, or is it based on? I mean, Google is
cash generated.
Cash generated, yeah, because Google already has higher margin. It's a higher margin business. I would say I'd pick Apple, but it could be either. My gut feeling would be Apple, but.
No. I just know I put this one in as a bit of tongue in cheek because I know how much you enjoy Apple products, and maybe in some ways it's a bit of a contrast with Google.
Well, I think Google is a great company. I've recommended Google in at least a service that I run. Again, it's a great company. Actually, it has been, even the shares today are priced at a very at pretty reasonably, as I said. If you look at free cash flow multiples, for example. So I think again. Like Google is a great company. I think Apple's a great company. If it's share dollars, maybe Apple, but I could be wrong. My issues with Google are mostly around privacy and things like that. I'm not a big believer in selling data for making money, but well, that's a business model.
It is. It seems to be profitable so far. Okay, so I've got two more questions. One of them is going to be a bit longer, but it's so interesting, and I just had to ask this of you. Given your focus on technology, what are some of the industries or technologies that you are most excited about? Maybe as an investor, for humanity's sake, maybe as a consumer, however you want to cut it up. What are you most excited to see, and what are you seeing today?
From humanity's sake, I think a couple of things I think are very interesting. Or there are several things I really think this the messenger RNA technology. That Pfizer and Moderna are sort of, are examples of for the COVID vaccine. I think that's really cool because this is plug and play vaccine technology. You can modify the vaccines rather rapidly. and the efficacies that they sort of have got are around 95%. That's traditionally unheard of in sort of the traditional vaccine world, right? I mean, a typical flu vaccine has 40 to 60%, for example, efficacy. So I think the progress, one of the, if there is a positive that has come out of COVID, it is that probably people have realized that the amount of time we spend trying to get these drug companies to actually move technology through the pipeline, it's way too long, right? And it is, I think maybe that there are other ways to keep it safe and still make it very efficient. That's number one. I think maybe that realization will come through. And number two is, this is the first time we have sort of seen application of this mRNA technology, which can actually be applied. I think, people were developing this for things like cancer and other, dreaded disease like Parkinson's and whatnot. So that could be a huge leap for humankind. I think that's really, I think leaps happening in space technology, I think are really, really cool because, that can open up a lot of other options in terms of not just interplanetary people, but, even mining in outer space, or using outer space for internet communication to rural areas or places where you don't have good internet connectivity. I think that sort of is.
Anirban, I
yes.
might just interrupt you.
Yes.
I actually bought the Starlink package. I don't know what you call it, where you get the hardware, you put the deposit down. I bought based on your tweet and what you were saying about it. I went and put down my deposit. So when it comes in 2021, hopefully
it comes in 2021. Yeah, like again, my NBN, at peak gives me about 25, 30 megabits per second. This one can go between 50 and 150, or 150 and 200. So I'm thinking, somewhere around 100, low latency, and it should improve over time because of the way the technology works with the more satellites and things like that, algorithms and hardware over time. So I don't think it disrupts fiber to home or high speed internet in sort of the heart of the city or in the inner cities, but it does make internet available to wide swaths of people that would otherwise not get internet. I think that is transformative, not just for the internet's sake. It's transformative for people because it would probably allow somebody in rural Australia to actually do a startup, because now they've got fantastic internet, as an example, right? And then that extends not just to rural Australia, it could be Africa, it could be India, it could be anywhere, right? So I think that's fascinating. I think those sort of things, and I think alternative energy, and green energy and distributed power, I think those are all great things for the sort of society long term. And I think those are sort of the things I'm excited about. Actually, none of these have got much to do in that sense with software. Everything has software, but they're not. None of these primarily as software plays, if you think about it.
Yeah, there's so much to go on, Anirban. I've already gone so far through this conversation. Hopefully, I can have you back on the show and we can do this again sometime, because you have so many insights to share. Motley Fool members are privileged to get these insights regularly, both through Extreme Opportunities and Motley Fool Pro. One final question, one piece of wisdom that I like to get from all guests, as you know, is just the one piece of advice you would go back and tell yourself about money, finance, or investing. It can also be life advice, but something you would have told maybe to your younger self as you're doing those research, those theses. What would you have told yourself about investing your money?
Yeah, I think the biggest lesson for people would be that I think the earlier you start investing, the better it is. And I think that allows you a couple of advantages. You can make mistakes using small amount of dollars and learn. And then you get better as your earning power improves over time. So you can actually make the most out of your dollars. I think I think investing again is a very long-term pursuit. So keeping that long-term focus and just investing early and just investing over the long term. I think investing can be very rewarding. But I think the other thing I would say is that, find the passion find businesses you're passionate about, because that helps you learn about those businesses and also learn about areas that are sort of associated with those businesses. And learning itself, buying itself, is a fantastic thing, because it just broadens your mind, broadens your horizons, helps you understand different things. So yeah, I'd say start early and learn about the businesses you're investing in. And Yeah, and I guess take a long-term view. Those are sort of three things I would say are critical to being successful. And and I'm jealous of people who start at 20 and are going to invest till say 60 because they'll be very, very successful if they do it well.
That's wonderful advice, Anirban. Thanks for taking the time out to join me on the show today, mate.
Thank you, Matt. Thank you for having me.